Scott, to get us started, give me two truths and a lie, please.
I am a national pickleball champion. I was the captain of two NCAA championship teams, and I climbed Mount Kilimanjaro.
Well, those are excellent. As a racket sport guy, I'm fascinated now. And I'm also fascinated in the idea of Mount Kilimanjaro, but that's not necessarily important. So, national pickleball champion, two-time national championship in tennis, and you climbed Kilimanjaro? Those are what you said? Okay.
Those are three.
I
What do you say? Which one's two truths and a lie?
right, right. The lie is that you are a national pickleball champion.
That's correct. And
Yes.
you, as a pickleball player, probably actually kind of figured that out. But yes, I play pickle. I like it, but I'm not playing competitively.
Well, one of these days,
There you go.
maybe. I don't
There
know.
you go. There you go. There you go. There's time.
There is time. A two-time national champion in tennis. That is incredible. And obviously climbing Mount Kilimanjaro. Which was harder?
I mean, the tennis thing, it's kind of that's a kind of lifetime achievement. So, I mean, not that Kilimanjaro, I guess, kind of isn't, but, Kilimanjaro, there's nothing really technical about it. You just kind of be in decent shape. And uh, they give you a nice saying that says pule pule, which is just one step after another. And, you get to the top of the mountain then. So, no, I take a lot of pride in the tennis accomplishments, and Kilimanjaro was fun.
Yeah. Poulet poulet.
Pule pule.
That is pretty great right there. One step
It
in
is.
front of the next.
Yep.
I
Yep.
love it.
It
I
really
love
works.
it.
Yep.
All right. Good advice for life and becoming a national champion in pickleball or whatever it might be, and certainly in every endeavor. So excellent. Well,
Mhm.
sir, what is top of mind for you right now?
Well, our job is really to help people with their money lives and help them think through, their life goals, then build plans and portfolios that enable them to achieve those life goals. And so that's kind of our mission. And and we think we can really help people by helping them, accomplish this.
Is that getting easier or harder?
You know, so another thing is I teach the history of investing. I'm taught for 10 years at Northwestern, and in the end things don't really change that much. So I think behavioral stuff never changes, but kind of the answers in terms of building, high quality long-term portfolios uh, don't change. And the amount of information and noise that's out there, that makes it more challenging, but in the end, the fundamental advice really doesn't change.
Do you think as noise, technology, new stuff as AI has been promised or threatened to disrupt everything, how do you think it's going to change investing if at all?
That there's a whole long, list of technology revolutions, right? And so, from canals to railroads to radio to automobiles to PCs to the internet to AI, and they change our world. They really do. But, the actual winners are incredibly hard to identify. And how it plays out is really challenging. But the psychology of getting, really excited about things that are going to change the world, and kind of naturally getting ahead of themselves. I mean, this is just a recurring theme throughout the history of investing. So I think AI is going to change a ton of things like the internet did, but we don't know exactly how, and trying to predict exactly how that's going to play out is kind of a fool's game.
Yeah, yeah. Who knows? The
Right.
behavior piece, the behavior piece,
Mhm.
is that the things that helped you to become a great tennis player? There's a lot of behavior. how much of that is learned versus hardwired? So nature versus nurture. Does that apply to investing?
Wow, that's an interesting question. So, you know, tennis is a really individual game, right? So, it's on you. So behavioral stuff is incredibly important. So I was lucky. I was a with a tennis family. I was the youngest of three kids. The older kids played. So I just came along and but I was kind of taught, yeah, you're supposed to win. And you kind of go for it and then you're disciplined in the way you go about things. And so, hey, I just kept, I started early, got pretty good, and then just kept at it. So the behavioral stuff is enormously important. Uh it's about, you know, making intelligent shots on a regular basis, right? And if you don't, you're just going to get beat. And so it's the same thing with, to me, investing. It's like, hey, you figure out intelligent, ways to invest, and they're not always going to work, but over the course of time, they're likely to play out really nicely. So I think that there's some real similarities and huge importance in terms of the behavioral impact on both sports and investing.
Yeah. It's always fun to look for parallels, even where they might not exist. Scott, is passive index investing like participation trophies? Say we're supposed to win here, but is that winning, or should I be trying to find alpha?
Well, my view on it is that markets, are inefficient. Sometimes, they get ahead of themselves and they're overpriced, and sometimes they're underpriced. Now, trying to take advantage of that, we use this ocean analogy, which just says, "Oh my God, the ripples on the ocean are CNBC all day long, right? And oh my goodness, right? And then the waves. This is what institutional managers do. And I spent more than 25 years in the institutional business. And basically the idea is to ride the wave, basically say, hey, here's what the market is forecasting for the next year. Here's what I think is going to happen. And if I'm right, I'm going to do better than the market. And the reality is shocking statistics, 90%, of managers that, over the course of 15 plus years underperform the index, the benchmark, and then investor gets the benchmark minus their returns. So we end up thinking that the opportunity that is available is really what we call the tides. So it's the long-term mispricing. So major mispricings, and then they will revert to the mean over the course of time. And the thing about it is the smartest, brightest people who are, on Wall Street managing money, they do not have the long-term horizon simply because, and I was there, 5 great years, you get a ton of money in, 3 bad years, and you lose it, right? So you have to try and outperform in shorter term environments instead of taking advantage of the long-term opportunity, which I think is there very consistently, but it's very hard, and you need to be really patient. So the answer is I think you can take advantage of mispricings, but I think there's so much information, people are so smart out there that everybody beats themselves up. So the answer is find major mispricings and give them time to mean revert.
So give me tell me more about finding mispricing and then giving it time to mean revert. Those are probably obvious terms, but you need to walk me through it a little bit better or differently.
Yeah, no. So, you know, let's just take a look at the US stock market right now, right? So you have this incredibly bifurcated market where you have the top, I'll get the details wrong, but it's like the top 10 stocks are 35% of the overall market cap. And they are very expensive and in my view of the world, likely to be overvalued, right? The rest of the market is pretty reasonable price relative to history, right? And so, it's an example here where you could say, okay, let's try and bifurcate the market and figure out the areas of the market which are, reasonably priced or undervalued, and stay away from those that aren't. And basically that'll take time. I mean, our other, view is that international markets have underperformed for, incredible period of time, and that they now trade at discounts to their historical, and they're at a 50% discount, right, to the US. And I believe in US exceptionalism, right? And I think the US probably deserves a premium, but not a 50% premium. So it's over the course of time, and you can take a look at the numbers over time. Everything kind of mean reverts over time. And it can take a really long time. That's the trick. That makes
So
sense?
looking at the total stock market, I take myself, a lot of the time I'm really just focused on domestic equities, so American companies. But if we look at the international stock market, you're saying that it's 50% less expensive than it ought to be. And over time, the reversion to the mean is that it will be not 50% less expensive. So right now is the opportunity.
That's right. And so, I mean, I actually, it's 50% less expensive in the US, and I think the US is more expensive than normal. So it's not 50% less than it should be, but it's reasonably priced, and you can get a very good return with those stocks in a broad-based portfolio.
And so you still are a advocate or believer in playing that via some kind of an index, or are you looking for individual winners?
So, we use active ETFs. So again, they're broad-based, they're inexpensive, and they capture what we think is the underperformance. So, things like, um, you know, international, well, the other big mispricing out there right now is value, right? So it's again also underperformed for a really long time, and it's much less expensive than than it typically has been historically. And that's true really around the world, in the US and the rest of the world. So we can find indices that give us value exposure, and in the US and around the world. So there's different ETFs that capture what we are looking for very inexpensively, and very diversified way.
So
And
this
they're
is
very,
where we're benefiting from technology because
yes,
these did not exist a couple of years
yes,
ago, 10.
100%. They're a fantastic invention, and so really, really worthwhile. Yeah.
Now, the value of, do you call yourself a financial advisor, an asset manager? How do you think of yourself?
I say a financial advisor, and part of that is helping people just kind of figure out what their life goals are, and then actually developing a financial plan, and then building the portfolio is all a part of that. But I could call myself an advisor.
Yeah. And what you've just described, possible for somebody to do on their own?
Um, yes. So I'm going to take a step back, and just say, the one thing that I think is hidden in plain sight, but is enormously misunderstood, and that the average person can take full advantage of, is the fact that equities over long holding periods are much less risky than are generally understood, and frankly, than the risk models say. So it's simply because of this. I talk about this mean reversion, right? It just says when things get out of whack, they go back towards normal, right?
Mhm.
And so when stocks do really well, they do worse than average going forward. When they do really badly, they do better than average. So in the end, you end up having a pretty steady path. And there's a lot of data that kind of shows that out there. And so you end up having, if you own stocks over long periods of time, and by the way, you and I, even though I've got a lot of gray hair, have a long period of time in order to take advantage of that. And so basically, this notion, when you really are able to understand it, you could have higher levels of equity in your portfolio, and you need to match that with a financial plan to make sure that you've got enough cash where you're not have to sell your equities when things are down, and then your level of risk, where you can say, well, I'm only gonna I'm comfortable taking a certain drawdown, but not others. But the bottom line is, there is uh, holding equities for a long period of time is something that provides very good returns and much less risk than you think, and generally perceived to be. And so that's something everybody can do. But it gets back to one of the things about advisor is giving, folks the comfort when markets are down and, oh my God, do I have enough money to, continue to, provide for my family, right? And say, hey, this is just the way markets work, right? And by the way, this happens not infrequently, but the time it takes to get back to from the bottom of a bear market to the new peak is only about 3 years. So you just have to have the wherewithal to withstand that.
Our behaviors and answers, which is what we
Yes.
we kicked off our conversation with.
Yep.
When I have good answers, it can prevent me from engaging in
There
bad
you
behaviors.
go. That's exactly right. You're exactly right about that. And that's where an advisor can be really a helpful and we're side comment, but we're working with GMO, who's really highly regarded institutional manager to incorporate this mean reversion in financial planning and portfolio construction, so we can systematically provide clients with a sense of what are the probabilities, right? If you have, oh my God, the 5% worst return environment, that how much money are you going to have, right? That sort of thing. So you can say, well, even if you get the 5% worst returns, you're still going to be pretty good. That sort of thing.
So as an investor, I am better served making good quality decisions on the front end and being a permanent investor versus chasing trends, buying and selling in and out of positions.
100%. So all that Buffett stuff is exactly right. And the data on the success of market timing is just it's overwhelming that it just really can't be done. So you need to have a thoughtful, disciplined approach and stick to it. And the markets will change, and it needs to evolve over time as markets change, and so, but it's all about having a framework and sticking to it.
Are there a lot of people that come to you that have made their fair share of mistakes and they recognize maybe I'm not the best person to do this for myself?
It's a really complicated question. So, I mean, the answer is yes. There's kind of plenty of those, and there's plenty of people that just end up saying, "Well, I'm just sitting on cash because I don't want to lose it, right?
Mm.
And I'm afraid of the next bear market." And it's like, well, that's not, you're not helping yourself there. But the flip side of it is, hey, I was a professional institutional manager, and so I think I'm super smart. And then, I did a lot of things that weren't so super smart, right? Uh, and so I think even the most, sophisticated, uh, investment people do well to have kind of a guiding voice and a thoughtful framework. And there's a difference between being a super successful investment manager and doing a really good job with your money and trying to understand that difference and build a framework for all that is really important. So a lot of my job really is kind of, to some degree, convincing people that have done very well that they're going to be better off if they actually have a framework to think about investing from the current stage. And we all make tons of mistakes, right? And Markowitz, the father of modern portfolio theory, they asked him, the most sophisticated guy about how do you do asset allocation of that. They asked him, what do you do as personal portfolio? He's like, I put half in stocks and kind of half in bonds because I don't want, I want some growth, but I don't lose it. It's like, what, are you kidding me?
Amazing.
So, yeah. And so it just people, because, we're people, you're humans, we make all sorts of behavioral mistakes.
It's a feature, not a bug.
Yep. There you go. There
Even
you go.
Djokovic and Alcaraz have coaches,
There
Scott.
you go. There you go. Very good.
I
Very
love
good
it.
indeed. And very important.
Well, Scott, we're ready for that difference-making tip, even though you've already given us a lot. What do you have for us?
Well, again, the real difference maker is trying to understand that if you own equities for the long run, your risks are low. There's never been a period going back 200 years that U.S. stocks over a 20-year period have delivered a negative real return. And if you've got a 30-year horizon, which frankly, anybody to me under 65 probably has in this day and age, you've never had a 30-year period where stocks haven't delivered inflation plus 3%. And that's a fabulous return. And that compounding over the course of time is crazy. So, the answer is, I think folks can actually comfortably own more equities in their portfolio. Yep, you got to have a risk budget, but that's really the message that I think is underestimated and in some ways, again, very obvious.
Well, I think that is great stuff. That definitely gets it. Come on, Scott. Thank you so much for coming on. Where can people learn more about you? How can people engage with you?
Yep. The website is sbondinvest.com, and you can also look up Bondurant Investment Advisory on LinkedIn and get more information and engage if you're interested.
Excellent. If you enjoyed this as much as I did, show Scott your appreciation. Share today's show with a friend who also appreciates good ideas. Go to sbondinvest.com. Check out the great resources that Scott has and find him on LinkedIn as well. And I certainly appreciate your perspective and your philosophy. So I know that everybody else will too. Thanks again, Scott.
Super. Thank you, George. Really appreciate it. It's fun.
Finally, friendly reminder, there's never going to be anybody more interested in your financial success than you are. So act accordingly.